Good afternoon everyone and welcome to my crypto analysis channel. Today is December 19th, 2025. In the last 24 hours, Wall Street's smart money seems to be staging a quiet Dunkirk-style evacuation. Spot Bitcoin ETFs saw a staggering single-day net outflow of $161 million. While not a record high, the signal it sends is extremely dangerous. Are institutions sprinting for the exits? Is the crypto winter truly upon us? Meanwhile, the market's Fear and Greed Index has plunged to 21, deep into fear territory. Faced with these numbers, I'm sure many of you are feeling anxious. But don't panic. Today, we're going to apply the Wyckoff method, combining macro and on-chain data to peel back the layers, uncover the true intentions of the whales, and define the most rational trading strategy for the current market. Data and evidence. All right, let's dive straight into the data. I'll be breaking this down from three core angles: the battle between market sentiment and capital flows, the structural risks on the technical charts, and the liquidity truth revealed by the order book. First, let's look at the core conflict: sentiment versus flows. As I mentioned at the top, the Fear Index is at 21, and ETFs saw a $161 million net outflow. What does this tell us? It indicates that against a backdrop of weak macro confidence and stagnant market liquidity, traditional financial institutions, the TradFi money, are adjusting their positions. Their short-term value perception of Bitcoin is declining. This is the first and most immediate downside risk for the market. However, and this is a big however, when we shift our focus from Wall Street to the blockchain itself, a completely different picture emerges. Look at this on-chain flow chart. We can clearly see that large-scale on-chain transactions have actually resulted in a net inflow today. On one hand, institutions are selling. On the other, on-chain whales are buying. This is a classic divergence between smart money and the herd. Interpreted through the Wyckoff lens, this could be whales exploiting market fear for quiet accumulation or position rebalancing. While we can't yet confirm if these buying whales are long-term holders, this signal tells us one thing. At this price level, significant capital believes Bitcoin is undervalued. They are absorbing the supply being dumped by institutions. This significantly strengthens our confidence in a potential mid-term market bottom. Second, let's zoom out to the higher timeframes and look at the warnings from the technical charts. Take a look at this Bitcoin weekly chart. There are two signals here that demand our attention. First is the bearish price-volume divergence. We're seeing prices fall on continuously shrinking volume. In technical analysis, this is an unhealthy sign. It suggests the downtrend isn't driven by panic selling, but rather by an exhaustion of buying pressure. This type of slow bleed often indicates that the market might be forming a macro downtrend rather than carving out a bottom. Second, and this is critical, focus your attention on these two moving averages. The 20-week MA is trending down sharply, approaching the 60-week MA. In TA, when a shorter-term moving average cuts below a longer-term one, it's known as a death cross, a classic bearish signal. While the cross hasn't occurred yet, the trajectory is clear. Looking at the chart, the potential intersection point for these two MAs is right around the $84,000 level. Therefore, we might see a technical bounce or some support as price hits this zone. But we must be clear. This would likely be a corrective bounce within a downtrend, not a full trend reversal. Of course, long-term investors shouldn't be overly pessimistic. Let's pull up the weekly MACD indicator. You can see its long-term slope is still bullish. This tells us that Bitcoin's long-term bull market structure has not been completely invalidated. For hodlers, the key is to watch if the MACD's slope begins to flatten or turn as the price approaches the $80,000 psychological and cost basis level, and adjust your strategy accordingly. Third, let's zoom into the shorter time frames, the daily chart and the order book, to see where the liquidity lies. Here is today's liquidity heat map. The situation is quite concerning. Below $87,000, the bid support is extremely thin, creating what we call a liquidity vacuum. Notably, around the $84,000 mark, we are not seeing any significant bid walls from institutional players. This reflects that market fear has permeated down to the trading level, with most retail traders sitting on their hands, waiting for a clear directional signal. Now, looking at large order flow data, the key support level at $85,000 we highlighted yesterday has now vanished. This means shorts could easily sweep liquidity and push the price lower. Currently, new bid liquidity is clustered around $84,000, while strong ask-side resistance is capping the price at $88,000. This has effectively locked the market into a tight short-term range between $84,000 and $88,000. Strategy and conclusion. Okay, synthesizing all this data, let's formulate our final verdict and trading strategy. Today's price action has perfectly validated our analysis from yesterday. The bounce to the $88,000 resistance zone clearly lacked follow-through, leading to a rejection. This indicates a severe lack of bullish momentum. Therefore, here are my specific recommendations. First, for those already in long positions, keep your hands in your pockets. Absolutely do not add to your position here. High time frame risk is building, and it's better to miss an opportunity than to make a mistake. Second, for swing traders, you need to be a sniper, patiently waiting for your target. Your target is the $84,000 price level. Why there? Because it's the potential confluence of the weekly 20 and 60 MAs, and it's where new bid liquidity is concentrating. But be clear, I'm not saying to blindly mark it by the second it hits. You need to watch the price action on a touch of that level. Look for confirmation signals like a long lower wick, a spike in volume, or other signs of stabilization. Once you see confirmation, you can consider a small entry to play the bounce. Third, for those looking to short, I also do not recommend opening new short positions right now. Why not? Let's look at the ATR indicator on the daily chart. The ATR is currently contracting towards its mean, and we're not in oversold territory. In plain English, the market has not yet experienced a true capitulation event, a panic sell-off where volatility expands to its extremes. Opening a short in this choppy mid-range area offers a poor risk-to-reward ratio. To summarize, on the macro level, institutions are retreating. On-chain, whales are lurking. On the technicals, the weekly chart is flashing warning signs, while the daily range is tightening. Our core strategy is patience. Let the market play out and wait for a clearer signal. The market's short-term direction is being decided by the battle between the TradFi suits on Wall Street and the whales on-chain. And our job is to remain objective, follow the data, and not get swayed by market sentiment. Alright, that's all for today's analysis. If you found this breakdown helpful, please be sure to hit the like button, subscribe, and turn on notifications so you don't miss our next market update. I'll see you in the next video.